20 years ago, you could sink your teeth into a juicy Big Mac for only around $2.39. Fast forward to 2024, and you're looking at shelling out about $5.93 for that same McDonald's burger. And to make matters worse, it's gotten, a tad smaller too. The cost of that iconic Big Mac has definitely beefed up over the years. Well, inflation. That's it. Welcome to Fire Movement Lab, where we turn the sparks of financial freedom into a roaring blaze of action. We're here to ignite your dreams and help you take the reins of your financial future. So let's roll up our sleeves and make those aspirations a reality together. In today's video, I'm excited to share with you one of the best strategies to boost your earnings through bond investing. Over time, prices for goods and services tend to climb, which means your hard-earned dollars don't stretch as far as they used to. When it comes to reaching your financial goals, there's more than one way to succeed. Well, in this economy, it can eat away at your savings faster than you can say supersize. Basically, investing is about putting your money into things that could make you more money. Think of investing as planting seeds for your future wallet. You're taking a chance, hoping your money will grow and do well, instead of just sitting around doing nothing in your bank. These assets can range from stocks and bonds to real estate, commodities, and even cryptocurrencies, though there's always a bit of risk involved. But don't stress, because different investments have different levels of risk, so it's good to know what you're getting into. That's where videos like the ones right here on Fire Movement Lab come in handy. We're here to guide you and help you steer clear of those risky moves. So before I spill all the good stuff in this video, be sure to hit that subscribe button and give us a thumbs up. Alright, it's now time to dive right into today's main dish, bonds. What are bonds? Bonds function as financial tools similar to loans, but on a larger scale. Just like how we borrow money for various reasons, like getting a mortgage or asking a friend for a loan, entities like companies, cities, and governments also borrow money. They do this through bonds. So in return, this entity promises to repay the original amount, known as the face value, at a specific date in the future called the maturity date. Now, on top of repaying the principal amount, the issuer also pays interest to the bondholder at regular intervals. This interest, referred to as the coupon rate, can either be fixed or variable and is usually paid semi-annually or annually. Think of it like earning interest on a savings account, but with a predetermined payment schedule. Bonds are characterized by two main factors: their face value, representing the amount the issuer agrees to repay at maturity, and their coupon rate, determining the interest paid to the bondholder. Now let's explore its four main types: government bonds, corporate bonds, municipal bonds, and Treasury inflation-protected securities. Types of bonds. Starting with government bonds. Government bonds, often referred to as Treasury bonds, are issued by national governments to fund public projects and manage national debt. For instance, the U.S. Treasury issues Treasury bonds, commonly known as T-bonds. These bonds, since they are backed by countries, are seen as safe investments with steady prices. Investors trust in the stability of government bonds, making them essential for many investment portfolios. For example, imagine you put $5,000 into a bond for your city that lasts 5 years and pays 2% interest. Every 6 months, you get some interest on that $5,000. After 5 years, you get the $5,000 back. So the prices just hang out, influenced by things like interest rates, the economy, and, well, hate to say it, but also on how reliable your government is. Corporate bonds, on the other hand, are issued by corporations to raise capital for business operations. One best example is the Apple Inc. corporate bond. Apple issued bonds to finance different endeavors like research and development, acquisitions, and expansion projects. Their price is affected by the company's credit rating, interest rates, and how well the company is doing financially, and riskier corporate bonds usually offer more money to make up for the extra risk. Basically, corporate bonds offer higher yields compared to government bonds. Municipal bonds, or munis, are issued by local governments to fund public infrastructure projects. For example, the California Municipal Bond Fund includes bonds issued by municipalities in California to finance projects like schools, highways, and public utilities. Municipal bonds provide tax advantages to investors, as the interest earned is often exempt from federal, state, and local income taxes, making them good options for investors seeking tax-efficient income. Their value might fluctuate depending on the city's credit score, interest rates, and whether the interest income is tax-exempt, which, is usually the case. Lastly, Treasury Inflation-Protected Securities, or TIPS. They are issued by the U.S. Treasury to protect investors against inflation. So, for example, the Vanguard Inflation Protection Securities Fund invests in TIPS issued by the U.S. government. These bonds adjust their principal value with inflation, ensuring that investors receive returns that keep pace with rising prices. The adjusted price that is based on changes in inflation is measured by something called the Consumer Price Index, or CPI. So we've talked about the four main types of bond investments. Now, let's try to understand more how pricing works in bond investing compared to other types of investments. How bond pricing differs from other investment approaches? Unlike other investments, such as stocks, bonds are generally considered less risky. Why? When you invest in a bond, you're essentially lending money to the government or a company. And let's be honest, they're pretty good at paying back their debts. That's why bonds are often seen as a safer bet, especially for those who don't want to take on too much risk. While bonds may be less risky, they also tend to offer lower returns compared to riskier investments like stocks. That's because when you invest in stocks, you're buying a piece of a company, and if that company does well, the value of your investment can, of course, skyrocket. But if it tanks, well, you could lose a lot of money. Bonds, on the other hand, offer a more predictable return. You know exactly how much you'll get paid and when you'll get paid it. It's a win-win. Unlike stocks, which aim for long-term wealth growth, bonds are used to preserve capital and generate stable income through regular interest payments, appealing particularly to retirees and those seeking fixed income. Bonds are ideal for investors seeking a conservative alternative to the volatile stock market, offering a reliable source of income to those who have faced market fluctuations or prefer a steadier investment approach. Bond income strategies. Bonds offer two primary ways to earn: holding until maturity to collect periodic interest payments, providing a reliable income stream, and selling the bonds at a market value higher than their purchase price to capitalize on market fluctuations. For instance, purchasing $8,000 in bonds could potentially sell for $9,000, yielding a $1,000 profit due to changes in interest rates or the issuer's improved credit worthiness. Unlike stocks traded on exchanges like the NYSE, bonds are mostly sold over the counter, requiring brokers except for U.S. Treasuries, which are purchasable directly from the government. The over-the-counter nature of bonds can complicate price transparency. However, organizations like FINRA enhance market clarity by sharing transaction data, aiding investors in making informed decisions. With the steady returns and variety of options, bonds provide you with a reliable source of income even when the market is uncertain. So, don't hesitate to explore this as part of your investment strategy this year. Remember, the key to success lies in careful research, prudent decision-making, and a long-term perspective. If you have a specific question or area you want to learn more about, comment down below. And if you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more informative videos. This is FIRE Movement Lab, where dreams of financial freedom ignite into action. We'll catch you in our next video.